So that sounds easy enough, but there are a couple of things to cover here. First, the plan of whether to roll or close should be established at the onset of the trade, arguably before even selling the initial skate objective option. Investors should already see that there's further support or resistance, and that should guide their expectations to roll if the first level is violated. It becomes part of their plan before they even make the trade. They know what they're going to do if it trends more than they think it's going to. But then, once it's time to roll, the option price and new overall market scenario, well, that has got to make sense, and it's got to jibe with the plan, the overall original plan, in order to follow through with it.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 68, How Covered Calls Can Work Great in Trending Markets. Yeah, that's what I said. They can work great in trending markets. But before we jump in today, I've heard from many listeners that they've read my new book, Build Consistent Wealth with Options. Thank you so much, first of all, for buying it and reading it, but especially thank you for your feedback. And as a reminder, would you please leave a review on Amazon? The book has consistently been on the Amazon bestseller list since it's come out. And you taking a moment and leaving a review on Amazon can help us keep it there. Also, before we continue on, I want to apologize for my voice being just a little scratchy today. I was at an options conference last week, and, well, there was something going around there, and I got it. But I'm on the mend. So our next show, I should sound just like you're used to hearing me. I wanted to start out with a quick story today. And like most good stories of great men in finance, it's either completely true or just true enough that, well, I figure I'll tell it anyway. This one is about Henry Ford. Back in the early 1900s, Henry Ford had this idea. He wanted to build a V8 engine, not just any engine. He wanted all 8 cylinders cast in a single block. At the time, that was considered, let's just say, cuckoo bananas. So he brings his engineers all together and says, build it. And the engineers, being engineers, they did what engineers do. They looked at the physics, the manufacturing limitations, the metallurgy, and they came back and said, yeah, no, this can't be done. And so Ford's response was, oh, all right, well, build it anyway. Now, that's just the kind of leadership style that would get you canceled in today's day and age. But, back then, it just meant you were Henry Ford. So the engineers go back, they try, and they fail. They come back again and say, we've looked at this from every angle, and it's just not possible. And Ford says, oh, okay, well, keep working on it. So at this point, you can imagine the eye rolling in the room. These are smart people, right? I mean, you're an automotive engineer at the beginning of when cars are coming out. You're pretty smart. They're not being lazy. They're telling them what the data says. But Ford doesn't budge. So they keep going. Months pass. Nothing. Eventually, after a long stretch of frustration, trial and error, and probably a few This guy has no idea what he's talking about. Conversations over cocktails. They figure it out. They build the V8. And it becomes one of the defining engineering achievements of the era. Now, I love this story, not because it's about cars or even about innovation, but because it's about what happens when your assumptions run headfirst into reality, or what you think is reality. Because those engineers weren't wrong based on what they knew, based on how things had always been done. Their conclusions, they made perfect sense at the time. It couldn't be done, until it was. And this is where I want you to just let that sit for a second. Because if you trade covered calls, you've had your own version of that internal dialogue conversation. You put the trade on, you sell the call, you think, okay, this makes sense. I've got my income. I've got my cushion, my downside protection. I've got my plan. And then the stock trends up and it keeps trending up. And at some point you start thinking, all right, this is not how this is supposed to work. You start questioning the setup, the strike, the timing, maybe the whole darn strategy. Because based on your model, based on your experience, this move feels improbable, even impossible, maybe. But you know what? Markets really don't care about your model, or they don't care about what should happen. They care about what is happening. And trends, real trends, have a way of exposing that gap. Now, I'm not saying the lesson here is just to blindly build it anyway in your trading account and fight or whatever. That's a quick way to turn a strategy into a story you don't want to tell. But there is something in this idea of staying with the problem long enough to actually understand it. Because a lot of traders, when they hit that, this doesn't make sense moment, they bail. They abandon the structure. They chase. They over adjust. They assume, oh, the strategy is just broken. When in reality, they've just run into a part of the market that requires a different level of thinking. And sometimes the edge isn't in avoiding the trend. It's learning how to work with it, how to structure around it, how to manage it without fighting it. Those engineers didn't suddenly become smarter overnight. They didn't discover new laws of physics. They just stayed with the problem long enough to see something they couldn't see before. And if you've been in a covered call where the stock just keeps going up, right? Adjust up through the next strike, adjust up through the next strike. You know exactly what that feels like. So maybe the takeaway here isn't force it. Maybe it's this. Don't assume that because something doesn't fit your expectations, it's wrong. Sometimes it's just showing you where your understanding needs to go next. And if nothing else, the next time a stock blows through your strike and keeps running, just remember, somewhere an engineer once said, that can't be done. And Henry Ford said, just figure it out. When an investor is long a stock and the stock price falls and the investor buys more, we like to call that in investing average pricing. This phrase average pricing is basically acknowledging that you can't time the market. There's noise in the market, but you like the stock. And so if you liked it where you first bought it and now it's lower, you must like it more at this lower price. I like it here. I love it there. Buying more shares at a lower price lowers the average price paid for the shares now owned. But when a trader is long a stock or really any other positive delta options trading position and the stock price falls and the investor adds to it, well, when you're a trader trading an options trading position, we call that catching a falling knife. We have a different phrase for that, right? Not average pricing, catching a falling knife. And that wording, I think, is very intentional. It inspires the imagery. Don't do that, right? Traders cut losses fast and let profits run. Trade management decisions must be conducive with the reason for the trade. Is this a long-term value investment or is it a technical based trade? Is it the objective to skate on the option or to trade into or out of the stock? When a short call or put strike is tested by the stock crossing through it, the plan of whether to cut bait and close the trade or try again by rolling should already be in motion. Skate objective trades live on the edge of the reservation of investing near their neighboring tribe trading. A cycle is completed upon locking in a credit after a series of trades. So, hey, look, let's face it. You don't want long cycles, right? You'd love it if each cycle was just one cog, right? One wheel cog. Sell it, buy it back for pennies, sell another one, buy it back for pennies, rinse, wash, repeat over and over again for the rest of your life. Well, when things aren't so perfect, when does it make sense to roll? And when is it better to just cut bait, exit the trade? More often than not, skate objective trades, and again, skate meaning not wanting to get assigned, just wanting to make money on selling the premium. More often than not, skate objective trades are usually based off technical analysis. They are for me anyway. To what degree certainly depends on the investor's background, skill set, overarching investment goals, the regime that the market is currently in, specific opportunity that is at play, and other criteria. But skate objective trades are definitely more of a just grab some premium sort of trade. And they're not really an I plan to buy or sell the stock here sort of trade. And so having that extra component that some technical tools provide that favorably interferes with the log normal distribution curve, that, my friend, that is useful. That is an asset to you. Each cash secured put or covered call trade is likely going to have been set up initially with the strike price at or just below support for the cash secured put, or at or above resistance for a covered call. The presence of additional support or resistance levels, those can be very useful. That lends itself to rolling to help us set the next strike. In a newly established downwardly trending market, when the stock drives through support and thus through the put option strike price, if there's another level of support that is lower than that first level that it just went through, well, it might make sense to roll the put down and out, down to a lower strike, out to a further expiration, selling the new put at or below the next support level. And the same idea for a covered call. If the stock trends above the call strike and there's higher resistance, well, it might make sense to roll up and out and set that strike above that next higher level of resistance. Make sense? So that sounds easy enough, but there are a couple of things to cover here. First, the plan of whether to roll or close should be established at the onset of the trade, arguably before even selling the initial skate objective option. Investors should already see that there's further support or resistance, and that should guide their expectations to roll if the first level is violated. It becomes part of their plan before they even make the trade. They know what they're going to do if it trends more than they think it's going to. But then, once it's time to roll, the option price and new overall market scenario, well, that has got to make sense, and it's got to jibe with the plan, the overall original plan, in order to follow through with it. So let's look at an example straight from Build Consistent Wealth with Options. Imagine an investor is studying a stock that's trading at $148.12. It's been bouncing around between 145 and 155. It's been doing that for the past 3 months. The investor observes a strong support level at $145 a share, connecting like 5 inflection points at that strike price within the past 3 months. And there's more support lower at $140 a share. And that support is strong as well. The strike prices happen to be in $5 increments. At the onset, this investor probably thought hard as whether to sell the 145 strike or the 140 strike puts. We can infer that the investor would have had to go too far out in time to get a decent enough skate yield to make it worth it to sell the 140 strike put, and thus opted for the higher struck 145 puts. Fast forward, and the stock breaks down through the 145 support level as a result of an analyst downgrade. It closes at 144.53 and confirms the move by closing the next day at $143.76. It's the preference of the investor in this example to always want to see a confirmation candle before taking any management action. So now is the time. Assume in this stock, options under $2 trade in nickels. The plan is to roll down and out. The 140 puts expiring in 3 days are 30-cent bid. The ones expiring in 10 days are 70-cent bid. The 30 bid might look attractive doing the math until factoring in commissions and the fact the investor will probably buy them back at some point, which would be at a 5-cent minimum. Thus, the actual realized premium captured would probably be too small. The investor feels the 10-day puts are borderline. The skate yield comes out to 18.25% if they expire, but paying 5 cents to close the put would diminish the return some. Further, with the analyst downgrade and the fact that the stock has already confirmed the breakdown below support, a follow-through is more likely than normal randomness would imply. The investor may not want to go through with the roll. Maybe closing the trade makes sense under this circumstance. If the implied volatility rose a little more and the investor could sell the put for a higher skate yield, or if the news was something the investor perceived as warranting a more fleeting move, well, then the better choice might be to roll. Thus, it's situationally based. The general rules of thumb for me is that I'm more likely to follow through with a plan to roll if, one, there's additional support or resistance. Two, I can get enough option premium on the option I'd be selling to open as part of the roll. And three, there's no new fundamental or technical information that's been introduced to significantly change my outlook for the skate objective. Now let's shift gears and talk about managing trade objective trades with the trending stock. Cycles are completed a little differently with trade objective trades compared with skate objective trades. With a strict trade objective trade, and again, trade objective trade means I want to get assigned and trade into the stock with a cash carried put or out of the stock with a covered call. So with a strict trade objective trade, cycles are completed either once assigned or once the need for assignment no longer exists. By strict, I mean the investor is only selling the option for the purpose of trading into or out of the stock exclusively. A looser trade objective would be that the investor does indeed like the stock in the case of a cash carried put, or doesn't love it anymore with a covered call, and is content getting assigned. And if assigned, they would likely continue cycling and take the other side of the wheel, going from call to put or put to call. In that case, a cycle can be thought of similarly to what we talked about before with the skate objective. The cycle is completed when a profit is locked in after a series of trades. The difference is the word profit is used here as opposed to credit. Profit can come from scalping the stock as well as from option premium. But trending markets make it harder to capture scalps resulting from assignment. In a sideways stock, if I get assigned on my 100 strike covered calls, I'll then typically sell something like the 98 strike puts. And if I can continue going from assign on the 100 calls, assign on the 98 puts, and scalping because the market stays sideways, great. But if the stock continues trending, well, the plan is unlikely to work. Let's go through another example, again, directly from my book, Build Consistent Wealth with Options. Imagine an investor owns a $97.24 stock and writes the 9-day 100 strike call at 92 cents. And after a week, we'll say the stock has crossed above the strike price and closes at $101.16, so $1.16 above the strike. The next day, it opens at $102.94. And the next day after that is expiration. The investor takes no action. The stock closes at 105.91. The call gets assigned. Okay. On Monday, the investor wants to continue the cycle by selling a put. The 7-day 100 strike puts are, in this case, we'll say bid 25 cents. The 14-day 100 strike puts are 40-cent bid. Not even a 10% skate yield. So neither of these are really great solutions. But the investor wants to avoid selling a higher strike put, ideally, which would have richer premium, but wants to avoid it out of fear of negatively scalping if the put ends up getting assigned, like the market comes back down. The investor can be getting frustrated. How can I get back in this stock without selling a higher strike put and risking negative scalping. This investor is falling victim to one of the key components of Danny Kahneman and Amos Tversky's prospect theory, specifically the component embedded in prospect theory that we call reference dependence. Reference dependence is the idea that people make decisions about gains and losses based on a reference point. The investor in our example had the $100 strike price just stuck in their brain. Does it matter that the investor sold the stock at $100 when assigned? Really, no. But the investor figures buying the stock as a result of put assignment for more than $100 would be a losing trade. There are a couple of realities that we have to wrap our head around here. Imagine now, after having sold the stock at $100 upon call assignment, the investor in our example sells, say, the 102 strike puts for 85 cents. And wouldn't you know it, the market turns around and ultimately the investor gets assigned on those 102 strike puts. So in this example, he or she would have bought the stock back $2 higher than where it was sold upon call assignment, locking in a $2 loss. But the option premium that was collected was $1.01 on the first call that got assigned and 85 cents for the put that got assigned as the second cog in the wheel, which leads to a total premium of $1.86. So negative scalped out $2, but have $1.86 in premium. Okay, the trade's still down 14 cents, but one more option sale could easily overcome that overall insignificant loss. But in fact, this is still misdirected thinking somewhat also. Even though the investor thinks of the trade as part of a cycle, which is definitely helpful for tracking things like P&L and cumulative discount effect and all, they are also two separate trades. The initial covered call trade made money, right? It had an if called return of 3.8% and got the math here reading this right out of the book. $100 strike price where the stock got sold minus $97.27 where the stock was, plus 92 cents divided by the stock price of $97.24. That's a 3.8% not annualized yield. And the prospect of selling the 14-day 102 strike put at 85 cents returns a skate return on cash of 0.8%. 85 cents of premium collected divided by the strike price of 102, that's 0.8%. Well, annualized, that's 21.7% if the put skates. And look, regardless, this is still just two trades into a cycle. Odds favor, statistics favor a positive expected return as the cycle continues. It's not necessary to trade the same strike price. It's not. It doesn't really necessarily matter. Our brains think it matters because and only because of reference dependence. Wheel traders are doing something different from plain buy and hold investors. They're making an expected value on each iterative trade. Each profitable cog in the wheel might have a component of the P&L attributable to the stock price action, or it might only be attributable to the options premium collected. Wheel traders are trading, if you think about it, we're really trading a basket of two different assets. We're trading stock and we're trading volatility. Volatility, which is the basis for how we think about option premium can and should be thought of as an asset class in and of itself. And that about wraps it up for the show. That's about the most my voice can hold up today. Sorry, folks. But before you go, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you subscribe to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more out of what we talk about with a paid subscription. With your paid subscription, you'll get video extra podcast episodes, so you can get hands-on video training on things we talk about on the show. Subscriber-only posts where I'll drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash cured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much more. And the best part is your paid subscription helps keep this show on the air. And by the way, it's been a while now, and I apologize, but I'd like to take a minute to thank some of our newest paid subscribers. Thank you and welcome to Brian M. is a new paid subscriber. Welcome to Jace, to Ann B. Welcome Scott. Welcome Gwen S. And welcome Lillian. And if I missed anybody over the past couple episodes, I apologize. Write in and I will for sure read your name next time. I don't want anybody to feel left out, especially if you are on this list of paid subscribers. Now, to join the list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com. wealthbuildingpodcast.com, and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching, our Smart Income video class, and you'll get a signed copy of my newest book, the book that this entire podcast is built on, Build Consistent Wealth with Options. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.